Next one.
Third worst Dow performer this year. Joining us now, William Trading's Sam Poser. Sam, you say there are 3 things that Elliott Hill should do off the top. Install leaders who know the business, get products out of the workshop that might have been overlooked that could get things going quickly, and get boomerang employees with knowledge back. Which one is more important?
I don't think there's any one thing you need to do. I mean, I think that, if you get your people motivated and with a plan, I think, that's going to get the ball rolling. All of this is going to take some time regardless, but without, the initial reaction we've heard from the Nike folks and even from people that have left Nike was exceptionally positive, and I think that will roll right over into sort of better results more quickly. What quickly means is
right.
It's the question.
It remains to be determined. So, Sam, how soon before we know whether the wholesalers, the partners that Nike sort of abandoned, is going to forgive Nike, and whether that piece of things might turn around relatively quickly?
Forgive Nike, like they have no. Do you want to sell product? Do you want to go bankrupt? Like, it's not like Foot Locker and Dick's Sporting Goods are going to be like, you guys didn't give us as much product over the past few years, so therefore we're not going to carry as much product. No, of course not. Like, do you want to make money or do you not want to make money? You don't have Nike in your stores and your Foot Locker, or you're any of these other retailers, okay, go bankrupt.
Well, Nike's still everybody's potentially largest customer, so
exactly.
I don't think forgiving is the question.
Yeah.
The question is Nike going to put the necessary resources against the wholesale partners that remain, which they didn't do even with when those partners were when many accounts were canceled, for all lack of a better term. Now that they're potentially bringing some of those accounts back on board, how are they going to manage that with product and resources? And the recent announcement that Tom Petty is going to be the GM of North America, and based on our checks, the conversations that are occurring all have already improved pretty much across the board. The problem is there's still not enough good product to get everything to work. And remember that even with Nike struggling at a lot of these accounts, it's still their largest vendor, and they still have lots of leverage with both existing and those accounts that would love to have them back.
Yeah. Now, something to keep in mind in regards to Nike stock is, remember what we spoke about earlier, tax loss harvesting. Nike, you saw the stock. It's been a bad stock this entire year, right? You want to talk about another stock that could potentially face some tax loss harvesting over the next, we can call it 45 trading days? You're looking at it right there. You're looking at it right there. Over this next 45 trading days, there could definitely be some tax loss harvesting. Nike's a widely held stock around a lot of investment funds, around a lot of big investors. And so if you're looking for a place to write off some gains against this year, there it is. There's your Nike, right? Which me, as somebody that's buying the stock actively right now, I'm like, please sell me every share. Everybody benefits, right? Sell me your shares at 78 and 77 and 81 and 82, right? I'll gladly take them off your hands. And then these people, these big funds and whatnot, they get to write that off against their gains. It's all beautiful. It's a win-win.
You just hit on my question for you, and that is how much hinges now on the product pipeline, and perhaps with it, the talent pipeline as well, especially when you do see a lot of Nike veterans who are potentially going to be coming to the table here.
Sure, a Terminator.
So, I believe this. I've written about it. I cannot prove it. That I believe that given Nike's focus on Air Force Ones, Dunks, and Jordan 1s, there was probably a good deal of product that were made or samples made that never saw the light of day. So I'm guessing that they can go into the sample rooms and say, oh, this is a better shoe than the previous administration gave it credit for, and we can potentially commercialize that more quickly. Now, that range is probably 12 to 18 months. The 12 months would mean something that's in the sample room, they can get made, show it to people, and then have it 6 months later. But they've already written orders through we're in October now. So through March of next year, that puts you probably, into fall next year, on the short run. And 6 months from now, the retailers will start to see that product, get a first look at it, and then we'll start getting feedback on that. So we'll sort of know changes in the air probably within the next six to 9 months, but how that shows up in the numbers will take a little bit longer than that.
So, the thing with Nike that's so interesting is, sure, can they innovate faster and, having a better product assortment? Sure, there's room to make progress there. There's no doubt about that, right? But the biggest thing that can help Nike is the bottom 60% of income earners being in a much better position next year than they have been this past year, right? Going into 2024, you came off of huge inflation, the biggest inflation we've seen in decades, 2022 and 2023. And that makes it very difficult for a lot of folks to be able to afford these sorts of products, right? Like, if you ain't got it, if you ain't got the extra $150 to spend on a pair of Jordans, you can't buy the Jordans. It doesn't matter how cool they are. It doesn't matter what they innovated on. It doesn't matter that they got the most advanced running shoe in the market right now. All that's irrelevant if you ain't got an extra $150, $200 around to go buy that after your paycheck. It's not rocket science here, right? This is like economics 101, business 101. So the biggest thing that could help Nike is not innovation. That can help, no doubt. But the biggest thing that can help them is finally in 2024, we've had a year where the consumer hasn't really been hit by inflation that heavy. If things bode well into 2025, the consumer could actually be in a stronger spot, which then they might actually be able to afford a new pair of Nikes, which would be great. Because, yeah, sure, can the top 40% of income earners, can they go? Yeah, sure. They're going to eat at the restaurants. Cheesecake Factory is having no shortage of customers, right? North Italia is having no shortage of customers. The Wynn Resorts is having no shortage of customers. But what about for the bottom 60%? That's where the real weakness is. You hear from Starbucks, you hear from McDonald's, you hear from all these companies, right? I mean, heck, Walmart's doing good. That's not a good sign. Whenever Walmart's doing good, not a good sign. I'm just telling you guys. And why have people been trading down to Walmart? Well, because they need to trade down to Walmart. It's not rocket science, man. Hey, I want to thank you so much for watching that clip here today. I hope you really enjoyed that one. What you're looking at right now is 1000xstocks.com. 1000x does not just show you a billion different metrics that are completely irrelevant. It's curated, mandatory metrics, advanced metrics, curated for long-term investors, not for traders, so you can understand a company on the highest level possible, how it operates, and most importantly, making judgments on whether you want to invest capital into a company or not. Understanding the upside, the downside with companies. Is that company worth our investments, or shall we keep our hands away? So how you can access 1000xstocks.com is you can go to the description area of this video, or you can go to 1000xstocks.com, apply for access to the service. PayPal. So PayPal, yeah, the stock's going up a lot, right? We're already up 28% now on this position, up $55,000. But here's the deal in regards to PayPal. Listen, this stock is still a phenomenal opportunity when it comes to this company. It's a phenomenal opportunity, right? If we go ahead and we pull up charts here for PayPal, we're going to see exactly what you want to see. You want to pull up a trailing 12-month of PayPal, right? Because that's going to give you a better gist of really what's going on in regards to this company, right? Trailing 12-month is up and it's up and it's up and up and up and up and up for this company. It's going to continue to go up, right? When it comes to trailing 12-month revenue, that's what you want to see in regards to a company like this. Like we go back here, $22.8 billion right around here, right? Q1 there. And now Q2 here, we're at $31 billion plus run rate. And so my opinion is PayPal continues to grow at a high single-digit or low double-digit revenue growth rate for years and years to go in the future. But meanwhile, we're going to start seeing that net income really start to fly. We're going to see major share buybacks, which is going to help the earnings per share immensely for this company. So when I look at PayPal, I love what I see in regards to this company. And the fact that it's trading at under a market multiple on PayPal, oh my gosh, like you got to be kidding me. Like look at this, we're at 18 forward P. The market in general, many of these stocks are trading 18 and 26. So, and we're going to get way better growth with PayPal. So I'm feeling great about this one. Chris is running this show on a phenomenal level. Oh, do I feel great. Amazing's on Amazon. So now we're up 69% on this one, up $85,000. In regards to Amazon here, okay, this stock, listen, this stock is a buy. It's a buy today. I wouldn't mind buying some more shares today. Am I going to personally go buy more Amazon shares in the public account? The answer to that is probably not. And the main reason being is there's just a lot of other opportunities for me to add. And Amazon's already a pretty darn big position for me. I have a position that I like. It's over $200,000. But honestly, if I had $1 million in Amazon, would I really want to sell it? I wouldn't. Like this company's trading very undervalued right now. When you look at the forward P, the 2-year forward P, you know, let's have some fun here. Let's run some numbers on Amazon, and you'll begin to understand why this company actually is undervalued today. So Amazon, I think it's fair to assume this company will grow at 12% top line on average per year over the next number of years, which puts them in 2028 at over $1 trillion of revenue, which will be the first company to ever do that. Now, the bottom line should go up much more rapidly than that. I would say about a 16% number is not like a crazy number at all. Now, Amazon's usually going to trade between a 30 and a 50 P ratio, somewhere in there, right? And with those sorts of growth rates and how sticky their business model is, you got to understand, like, once you get into AWS ecosystem, you're not leaving AWS. Additionally, once you get used to shopping on Amazon, the e-commerce side, you're not going to stop shopping like that. Like, of course, that's going to be the way it is, right? And so you look at this company, and it still is an undervalued asset. And this puts them at only 9% net income margins. I think they're going to get way above that. And so even at these sorts of kind of very sleepy numbers, is going to be immense growth ahead. But I think they could probably grow 20% on average, bottom line, pretty darn easily over the coming years, which then gets them to a net income margin around 10% come 2028, which I think in 2028, they'll be double digits. It's a big question to me if they're going to be like 10%, 11%, or 12% net income margins come 2028. So in this sort of scenario, you know, compound annual growth rate on the low end of 11%, high end of 27%. And those are not hard numbers to imagine there with Amazon. So Amazon's still a buy today. Hey, I want to thank you so much for watching that clip here today. I hope you really enjoyed that one. What you're looking at right now is 1000xstocks.com. 1000x does not just show you a billion different metrics that are completely irrelevant. It's curated, mandatory metrics, advanced metrics, curated for long-term investors, not for traders, so you can understand a company on the highest level possible, how it operates, and most importantly, making judgments on whether you want to invest capital into a company or not. Understanding the upside, the downside with companies. Is that company worth our investments, or shall we keep our hands away? So how you can access 1000xstocks.com is you can go to the description area of this video, or you can go to 1000xstocks.com, apply for access to the service. Shopify. Ticker symbol SHOP on this one. It's an $81 stock here today. And the stock price is up 2,800% since they went IPO. Now, when it comes to Shopify, e-commerce company, right? And here's where we are right now in regards to this one. This shows you Shopify's trailing 12-month revenue over time, right? And this is what their projected revenue is expected to do based upon analyst estimates here. This is a company that has decades of growth ahead. And it's an asset like Amazon. That's the way I look at it. Amazon went very asset heavy. They wanted to have the whole distribution network. They wanted to own massive warehouses. They wanted to have the trucking fleets, right? They wanted to have it all. And so Amazon decided to go very asset heavy. Amazon's a company I personally own. I love Amazon, right? And they're also very asset heavy when it comes to their AWS business, right? A lot of assets when you're going to run an AWS. And it's beautiful. Great for them. But asset-light business models can also be beautiful when you focus on mainly the software, because that produces you not as much revenue potential, right? Amazon's going to be a company that's going to do $1 trillion plus of revenue. Is Shopify a company that will ever do $1 trillion plus of revenue? Absolutely not. But could Shopify's margins be exponentially better? Could their profitability be exponentially better? Yes, right? Yes. And so when it comes to Shopify, it's an asset like Amazon is the way I look at it, where it just has unbelievable growth over the coming decades, right? Now, when it comes to Shopify here, we look at a trailing 12-month of their free cash flow, and it's clear as day. It is a rocket ship ride in regards to Shopify. They were doing under $100 million of free cash flow on a trailing 12-month basis just a few quarters ago. And now they've already popped that to well over $1 billion plus in trailing 12-month free cash flow for this company. And that's just a matter of a few quarters. Imagine where Shopify's free cash flow is going to be 3 years from now, 5 years from now, 10 years from now, 20 years from now? Can you imagine the free cash flow this company's going to be pouring off in those years? And keep in mind, what are they going to do with all that free cash flow? Are they going to do massive share buybacks? Are they going to buy out other businesses? Are they going to keep adding to their incredible engineering force at that company, right? What are they going to do? Like, there's so much optionality with all the free cash flow that's going to be pouring in for Shopify. Now, one of the beautiful things with Shopify, and one of the things I really appreciate with this company, is they're a company that every business can use them. It could be a mini-sized business. Just one employee that's a solo entrepreneur, right? The solo entrepreneur, he's just starting his business, she's just starting her business, right? Boom, they can use Shopify because it's there for them, right? It's affordable. The small business that might employ a couple employees, right? They can afford Shopify. The medium business that might have 10 employees to 100 employees or maybe a few hundred employees, they can use Shopify. And the large companies that have thousands or tens of thousands of employees, if not hundreds of thousands of employees, they can use Shopify as well. Doesn't matter where you are, Shopify, they're the ones for you at the end of the day, right? Check this out. This is our monthly recurring revenue. Monthly recurring revenue. It is now up to $169 million in monthly recurring revenue from their subscription plans with their customer base. That's incredible. Now, Shopify can make a lot of money a lot of other ways outside of just their subscription plans, right? But I think this is very important because that's going to be there month in and month out, right? Which is incredible. And, is there a day in the future where Shopify has $500 million a month coming in recurring revenue? Recurring revenue. $1 billion a month? Yes. That's coming, right? And check this out. If we go back to kind of 2019, they had 5 years ago, so $47 million in monthly recurring revenue, and now $169 million. Incredible what this company's doing, right? Now, you may look at Shopify, you might say, it's an expensive stock. True. It's forward P is 69 in the stock. Yeah. Now, keep in mind, Shopify could beat those numbers, so maybe it's a 55 forward P or 58 forward P, right? Because maybe they beat analyst expectations, which they probably will beat analyst expectations over the next year. So, but still, even if, let's say, it's a 55 or 59 forward P, it's still very expensive when you account for most stocks trade at like 18 to 26 range, right? But here's the deal. Special companies trade at very high valuations. If we look at Amazon over time, right? Amazon, throughout much of its history, has traded at a P ratio of over 100, or even like negative PEs over time because Amazon was losing money. And that's much of the past 25 years. It wasn't really until very, very recently that Amazon got reasonably valued with PEs somewhere in the 30 to 50 range, right? But that's because Amazon's at a different stage in their business model where people look at Amazon as kind of like a company that's going to grow revenue high single digits to low double digits per year, versus Amazon used to be a company you could count on growing 20 to 30% revenues year in and year out. So Amazon's just at a different stage now because law of large numbers has caught up with them, right? And so Amazon's still a growing company, but it's just not those insane growth rates. Shopify is one of those few companies that you're still going to be able to count on 20% plus growth rates year in and year out for years and years and decades to go in the future, right? Which is why Shopify certainly trades very expensive, right, compared to an average stock. So you got to kind of look past the valuation. You got to really focus on where these numbers are going over time, because Shopify might look expensive now at $100 billion market cap, but just wait until it's a $500 billion market cap and $1 trillion market cap 10, 20 years from now, right? And you'll look back and you'll be like, dang, like $100 billion market cap, man, I wish I was buying the stock then. So that's what ends up happening with these stocks. Amazon, I remember looking at Amazon when that company was just a $100 billion market cap, a $50 billion market cap many years ago, right? And thought, gosh, it's an expensive stock. Amazon's what, a $2 trillion plus company now? Now I look back and I'm like, dang, it was actually very, very cheap back then. So keep that in mind, okay? Elf Beauty. This is a stock that's done tremendous for me over time, up 1,382%. This is a stock that it's an incredible company, absolutely incredible company. Check out this chart right here. This is where we are right now, trailing 12-month basis when it comes to revenue. Beautiful when it comes to this. This is the sort of chart you want to see in your companies over time. Incredible what this company's done to become a major player in the cosmetics and beauty industry over the last number of years. Now, keep in mind, if you go into a Target store, right? Go into a Target pretty much anywhere in the United States of America and go to the beauty cosmetics area. And you're going to be like, oh my gosh, like Elf's the big player here. Like they usually have the most customers around their section. They usually have sometimes even the biggest section of any of the makeup brands, cosmetics brands out there. You'd be like, wow, like they're the big dog. Like you kind of get the feeling of like they're the big dog company. But the reality is, e.l.f. is still a little underdog in this category, despite all the shelf space they have now and all the volume they're doing and the growth rates they're doing, right? Look at this. This shows you these sorts of companies over time. Look at where e.l.f.'s at, right? A little over $1 billion in trailing 12-month revenue. Great number. It's nothing compared to these other guys. L'Oreal, $44 billion. Unilever, $26 billion. Estee Lauder, $15 billion plus. P&G, $15 billion plus. LVMH. I mean, you look at these numbers, these other companies, right? And L'Oreal being the big dog of the space. And you just got to understand, like, e.l.f. has a long way to go of growth. When we talk about companies that have 10, 20 years plus of growth, but here's the thing with e.l.f. that's so beautiful. If you look at their relevance with the younger generation, let's call it 30 and under, their relevance is higher than all these other brands probably combined, honestly. It's ridiculous in terms of their reach on YouTube, Instagram, TikTok, everywhere you really want to be. They're relevant with those sorts of folks, which are the next generation of folks that will be buying these products for the next 5, 10, 20, 30, 40 years, right? Now, when it comes to e.l.f., you look at the stock. It was $210 back in the summertime, and now it's $107 today, right? Had a massive crash in regards to stock. Don't get caught up in the short-term growth rates, because that's what a lot of people get caught up into. They get caught up in these short-term growth rates, and they feel great about the stock, and the stock explodes to upside. They feel bad about the stock, and the stock explodes to downside rate. And if I took you throughout e.l.f.'s history, the drops in the stock are significant when it does drop, right? This was a huge drop. This was a huge drop. And then this was like a monumental drop here recently, right? Don't get caught up in the short-term crap that goes on with this company. e.l.f. has reached escape velocity in regards to their brands in the cosmetics. They're on their way to becoming a giant in this industry. They're at escape velocity. Like, they're going to be big around the world because they're so big on social media. People know e.l.f.'s brand all over the world. And that's beautiful. So when they go to launch in a new country that they really have no real business there yet, they're already known on the ground by customers because they've seen it on Instagram, they've seen it on TikTok, they've seen it on YouTube, they've seen the products, they got interest, right? So it's unbelievable. So e.l.f. is a company that will be on the pace to be a $10 billion plus a year revenue company. They've reached escape velocity with this one, which is absolutely incredible, right? Now, e.l.f. today, about a $6 billion market cap. You look at something like L'Oreal, about a $215 billion market cap. Somebody like an Estee Lauder, which Estee Lauder's stock is in a bad place right now. Their stock has crashed immensely over the past number of years. Even after the insane crash with Estee, still a $32 billion market cap. So it really gives you some insight on how much upside really is out there for e.l.f., right? Now, when it comes to e.l.f., if we look at trailing 12-month earnings per share, right? Obviously, they're bringing in profits. They're not even really focused on profits right now. But the profits they are bringing in, they're going to be able to use those profits to either invest back into the business, right? Or they can buy up-and-coming brands. And that's something they've been doing where, like, look at this deal they did back last year. e.l.f. Beauty to acquire Naturium for $355 million. Now, this Naturium brand, big in the skincare space. e.l.f.'s not as successful in skincare. They're much more successful in cosmetics. So this is a huge breakthrough for e.l.f. when it comes to skincare. Now, this Naturium brand was expected to do about $90 million of revenue in 2023, and it's growing rapidly. So when we think about, like, where could that brand be? My guess is e.l.f.'s going to be able to scale that brand out to be able to do hundreds of millions of dollars a year in revenue, if not billions of dollars someday, right? It's going to be a growth over time. And keep in mind, e.l.f. has distribution and getting distribution now all over the world. So they're going to be able to buy out other brands and then get them that distribution much easier all over the world, which is absolutely phenomenal, right? So they're on their way to becoming a true cosmetics giant and not just a more niche player or a smaller player in the market. They're on their way to becoming a giant in this industry.